Yeah, hello and good afternoon in my case. My name is Klatt. I'm located here in Berlin, Germany, and it's early afternoon in our case, so nearly noon. Should be noon in London. Probably it's early in the morning somewhere in the US. Or on Tahiti at the beach, I don't know. Wherever you listen to this webinar is an international webinar, and I hope that I can give some insight, some value for your trading in the upcoming 45 minutes with an outlook for the upcoming week of trading. Currently, conditions are, very erratic, very thin. Probably some of you had already have a look at the DAX, for example. Very choppy price action, short stint on the upside in the morning, then it came lower again, made new daily lows, now trading around 12,400 points. Same for the currency markets. We don't really know whether this will change or not within the next hours then into the weekly close. Probably there is definitely one event to mention here. It's the Jackson Hole Symposium, where especially the eyes are on Jay Powell, the Fed chairman, where the question is, will he react in some way or the other to the comments from Donald Trump from Monday, Tuesday, not sure, but at the beginning of this week. Let's see. Before we start, very important, we have to have a look here at the risk disclaimer, that you please make sure that you understand that Forex and CFDs are complex instruments and that they come with a high risk of losing money rapidly due to leverage. That you please consider whether, or that you please understand and consider the understanding here of CFDs in general, how they work, and whether you can afford to take the high risk of losing your money, and that you please ensure that you fully understand all risks involved here. And so the following here is my personal opinion, my view on the markets, and please, you can surely take it and probably think about it and probably take it as an idea. Nevertheless, if you take action on this, please make sure that you understand that you take the action on this, and you have to make your own opinion and your own view on the markets. So then, as of August 2018, 1st of August, 3 weeks nearly ago, the regulation with the European Union differs for retail clients and professional clients. And I want to make sure that you understand that here in this presentation, you will see only me using a demo account, where all clients could still use high leverage in a risk-free environment. And before opening a live trading account, that you please consider the difference between retail and professional trading terms. Sure, there are several reasons why you should choose Admiral Markets as your broker, especially here in Germany. Admiral is considered to be the DAX expert, with a typical spread, by the way, of 0.8 points during the main trading hours. During July, there was a time when you were capable of trading the DAX with a spread of 0.5 points. So that was really interesting, and based on the fact that the DAX turned 30, it was his 30th anniversary, and you got the gift for it. So it's definitely worth to give Admiral a closer look here. Then let's have a more detailed look here, even though it's only a rough overview, nevertheless more detailed than what I already said around this ESMA decision, the important changes for Forex and CFD trading. Now we have in the retail environment leverage restrictions for all retail clients with a maximum of 1 to 30 for Forex majors like EURJPY, for example, but also 1 to 20 for other currency pairs, so-called minors. Some of you might have seen me drawing some or doing some research on GBPUSD, for example, where the leverage is 1 to 20. But also CFDs like the DAX has a leverage restriction to 1 to 20 here. The same is true for gold. And there's nevertheless the chance here to keep the high leverage if you fulfill the necessary steps here, which needs to be fulfilled if you are professionalized, if you're a professional client, then there's no leverage restrictions. In case of Admiral, usually there wouldn't be a negative balance protection. But in case of Admiral markets, you're safe up to £50,000 here, according to the policy. For further information, please contact Admiral directly. Here are the contact details. And then finally, now you also have an idea of who I am, who I look, how I look like, and that's it here around me. And now let's have a look at our agenda and start through, give an overview of what to expect for the upcoming trading week. So the questions we want to answer here: what are the key economic events in the upcoming trading week? The thing is, I can already say it, into the weekly close, not only into the weekly close, but also into the monthly close, the economic docket thins out dramatically, in my opinion, and there's not much to be expected. Nevertheless, in 2 weeks, so in fact, next week on Friday, when we'll have the next event here, we will see that there's plenty of really interesting news then coming, like the non-farm payrolls, for example. Some of you might wonder, okay, why are the non-farm payrolls now really interesting? It has something to do with the fact that the Fed decision at the end of September is around the corner, and the non-farm payrolls could probably play a more significant role now in terms of another rate hike. The one in September is already a done deal, if you want, nearly sure for 100%. You will see this in a few seconds here with the chart I will present from the Chicago Mercantile Exchange with the Fed Watch tool. But nevertheless, there's still some uncertainty around the fourth rate hike then in December. And with the comments from Donald Trump at the beginning of this week, yeah, the thing is that there could be some surprises ahead of us, which could also, by the way, then lead to quite strong drops in the US dollar. But unfortunately, this is only true for the 2 weeks from now. Next week, the economic docket is really, really thin. The question is, okay, what's the current bias in the FX, equity, and commodity markets? Therefore, we want to definitely also have a look at the so-called Commitment of Traders report. Data is quite old because it's from last week, Tuesday, was published last week on Friday. Nevertheless, we have a clear tendency, which shouldn't have changed much since last week then, especially in terms of the US dollar. And then, sure, we want to answer the question, which trading opportunities may arise. There is still gold quite interesting after a first corrective move higher and test of the region around 1,200 USD per ounce. But we go step by step and start out here with some statistics. Yes, probably we start out here with this chart first. So that's numbers around what I already mentioned in terms of the likelihood of a rate hike of the Fed. We only want to give a rough overview here. More details will follow then next week on Friday in the next weekly outlook for the week then to come, with the non-farm payrolls on the first Friday in September and everything around this. But here we only want to focus on those numbers that you have some proof that I'm speaking the truth here. So it's nearly a done deal, the rate hike in September. What do we see here? In fact, this is the probability for a rate hike on the 26th of September, Wednesday, 26th of September. Here, this is the current rate hike, the current level here, which is 175 to 200 basis points, and market participants expect a rate hike here of another 25 basis points by 98%. So it's nearly a done deal, and there's not enough data coming out in the upcoming weeks, in fact, that this will change dramatically. And also here, when looking at today's speech from Jay Powell, the Fed chairman in Jackson Hole, we shouldn't expect a dramatic shift here in his rhetoric. What do I mean with dramatic shift? So what we've seen from Powell over the last months, in fact, after he became the predecessor of Janet Yellen, was that he sounded quite strict and quite restrictive compared to Yellen, who was more, let's call her the neutral, a neutral chairwoman in this case. And so it was quite clear Jay Powell made quite clear what to expect from the Fed in terms of further rate hikes and in terms of the further monetary policy. Probably this is also something what Trump doesn't or didn't like to hear, and what he meant when saying that he's not really happy about the current rate hike cycle, even though we have to say, okay, what to expect from a economy really showing the clear signs of bullish momentum, let's call it. So I mean, rather sooner or later, it should have been expected that there will be rate hikes and there will be a rate hike cycle. And so in fact, one could also draw the conclusion that this is a positive sign, because now the Fed has to counter inflation picking up. Nevertheless, there's surely the question, okay, is it momentum the economy took on here based on a real positive fundamental outlook, or is it more because of the fact that the first signs of this aggressive quantitative easing after the financial crisis start to hit? That's the question. But nevertheless, the first thing to think about here is that this rate hike cycle should usually be a sign of a positive economic outlook here, a positive economic growth. And nevertheless, sure, Donald Trump, with his mantra, "Make America Great Again," is interested in getting the US dollar weaker. And this is especially true when looking at the export sector in the US. So he's not really happy, especially when looking at other let's say G7 currencies here, like the ECB, like the Bank of Japan, for example, or the Euro and the Japanese yen and their respective central banks, that they are still quite expansive with their monetary policy approach. And so this is now the question, will there be any comments today? All in all, whatever comments Powell will use, it won't change anything in terms of the rate hike here in September. Nevertheless, what could be is that probably Powell will at least try to take some pressure from the Fed here. Will probably, for whatever reason, give a comment which makes it unlikely that there will, or more unlikely, let's say, that there will be another rate hike then in December. So here you can see this is the current level. This is the level we should expect to see after this September rate decision here. And as you can see here, 225 to 250, plus those seeing, in fact, not only two further rate hikes, September now, plus December, plus probably another one. There are some optimists seeing two rate hikes here, up to 250, 275. Those have to be added to this 66.8 here. So making it a likelihood of, let's say, 2/3, so 67% around, that market participants, or slightly more than that, that market participants see a rate hike here, a further fourth rate hike. If there's any comment from Powell today which makes this unlikely or more unlikely, when we see a drop here, this could be, or this is the potential trigger for US dollar weakness here, which could trigger volatility, by the way, in then the financial markets. And then when looking, for example, at the euro and the current performance, so the euro was one of the strongest performers over the last days. It is, it's potentially a volatility guarantee then, and that we get to see a push significantly back above 116 in euro, for example. The same is true also probably for the equity markets, even though I'm a little skeptical that the DAX, in fact, could imagine that the stronger euro here weighs negatively on the DAX, while probably the US equities then stabilize around their current highs. But in fact, and this is to make long things short, what's important to mention is that today at this symposium here, at the speech from Jay Powell in Jackson Hole, at by the way, it's 3 p.m. London then, so 4 p.m. German time, that we should definitely carefully watch the developments at or in those probabilities here around the rate hike from the Fed in December. If there's any comment that makes such a step, a fourth rate hike in 2018, unlikely, more unlikely, this is a potential push lower than in the US dollar. So that means, so there's not real big momentum on the upside to be expected, to be honest. But what I expect is more like a neutral reaction if there is reformulation, let's call it, of the status quo, or if there's any hawkish touch to the speech from Jay Powell, however this should look like. And on the other hand, there's a chance that if there's any comment which tries to at least diminish the further upside momentum in the US dollar, that this could drive US dollar on a broad scale lower, based on the fact that the probability for a hike in 2018, a fourth hike in December, then comes in lower. So that's something we'll want to have a look at a little later on. Before we start here, first of all, this is the economic calendar showing, by the way, it's not accounting the symposium here in Jackson Hole. It's only focusing on economic news here in this case. So you can find, by the way, this economic calendar here when looking at admiralmarkets.com. Then here going to analytics and then on the Forex calendar. And what you can do is you can also choose your respective time zone, for example, the language. It's not only English, but it's also Espanol, for example, Francais, Italiano, and so on. And what you can see, now let's come to the data here, is that, in fact, yes, the data is thin. Sure, there are plenty of news events somehow. You can see, for example, that there's, for example, the business confidence or the growth rate here around Canada, which we want to have a look at a little later on also. But when looking at the US here, the major currency, you can see that there's only this GDP growth rate on Wednesday, and it's the second estimate. So let's see whether this is really such a big market moving event here, and everything else is kind of, let's call it, uninteresting. Same is true for today. Durable good orders, yes, they are probably interesting, but not in the current market environment, especially with Jackson Hole around the corner. That's one of the reasons why we do not want to give this year a deeper look then. And now let's have a look at the chart, and let's have a look here at the current price action. By the way, what you can also see is that I have a small position going here. It's a EURJPY trade. It's based on an approach which was made a topic already several times in several other webinars. It's an Asia breakout trade here in this case. You can see here those blue lines showing the high and the low of a certain range. Asian trading hours, in fact, we've seen the breakout here in the last candle that was around, well, how long is it ago? Yeah, something like an hour or so. Yeah, and so now the question is, will there be further momentum on the upside? Some of you might be surprised to see me trading the long side in EURJPY, by the way, because what you can definitely see is a clear extension on the upside. But what I can say is that after a quite difficult start into the trading week with this approach, the long side proved to be the right side of the market. And in fact, after a first loss at the beginning of the trading week, Tuesday showed a profit, Wednesday showed a profit on the long side, and the same is true for yesterday. It also showed a profit. Yesterday, unfortunately, the market didn't push lower. It was only something like we fell short of 12 pips or so, not reaching the net profit level. And the thing is that the trend is clearly upward, and even though you might feel uncomfortable trading here the long side from pure gut feeling, the system says trade the long side because the breakout occurred on the upside. And let's just see if this develops in the right way or not. If we make it above 129, again, this is, by the way, interesting to mention. That's one of the reasons why only the words from Jay Powell are really interesting to watch today, and why one is shouldn't probably expect too much. Haruhiko Kuroda, this is the president of the Bank of Japan, when talking about the Japanese yen, he's worth mentioning here, is not in Jackson Hole, because over the last days there was a notification sent around that Kuroda won't give a presentation here, which is, by the way, showing that the overall importance of this event, of this symposium, is not given, at least not this year. So it happened several times that Jackson Hole was the volatility guarantee after Ben Bernanke, for example, announced quantitative easing. Was it 1 or 2? I think it was not. It was minimum quantitative easing 2 in 2010. I think he came around with this, resulting in some big volatility here. But this year, I think we shouldn't expect too much from this event. And the first indication is that Kuroda is not there. As the BOJ president, I mean, we're still talking about, I think, the 4th largest economy in the world. So in this case, probably chances diminish. Nevertheless, I hope to some extent that from Powell there will be impulses delivered, which will probably, yeah, I think, well, if they are hawkish, if he comes out hawkish to some extent, then I think that the dollar against the Japanese probably will strengthen. The same is true for the dollar against the euro. But when looking at the performance of the last days, and also here, by the way, so look at this candle. The euro is still quite strong compared to the US dollar, and is, by the way, one of the strongest currencies here in the G7 G8 currency universe this week, especially against the US dollar. And so based on that, relative strength then probably plays out for my EURJPY trade, even though I still prefer not only the yen to weaken, but also the euro to strengthen if I'm EURJPY long in this case. But yeah, let's just see how this develops. So I have to be patient here just to see whether it works out or not. Well, so let's look at the Euro USD here in this context then. And from a technical perspective, it's very interesting. After the break lower here below 115, we took on some serious momentum. Nevertheless, we didn't make it to the projected target around 112. How do it come that I'm talking about 112? So I take the difference between 115 to 118 here, so the low of this range and the high of this range, duplicated on the downside, and this is the first projected target. Even though it's a rough approach, it's one which works really well, especially if you have trouble to find potential targets on the downside, respectively. If the market you're looking at here traded in this region the last time over 1 year or around 1 year ago, it's not significantly over, but nevertheless 1 year ago. So the significance of this region here, for example, could be questioned. But when looking with such or working with such projected targets, it works extraordinarily well. And so yeah, what about the current pushback here? I mean, this retracement we get to see so far, it's not more than that, nothing more than that. So it's not a serious sign of strength or something, but it's only a regressive move, pushing back towards a region which can be considered a potential short trigger, even though short term here, this region around 116.20 to 116.30 is interesting, because if we make it above that level, I think this reduces chances dramatically that we'll get to see a sharper drop on the downside here. But in fact, probably stabilize then above 116, probably push towards 117 and see some kind of consolidation. And if we get, or if we want to see further volatility, I think we have to be patient and wait for the Fed then to come, which is, by the way, especially true when looking at the thin economic docket next week. So with no important economic news around the corner, chances are significantly dropping for big intraday moves and bigger volatility if we make it above 116.20 to 116.30 here on the upside, because yeah, the technical picture then starts to worsen for the bears, and with no potential drivers there out there in the economic calendar, I think chances are dropping even more that we get to see higher volatility. The same is, by the way, true for GBPUSD. So GBPUSD nearly made it towards the target, which I made a topic in my weekly outlook several weeks. In fact, it was not only last week, but it was also the week before, 126. Thanks to the euro especially, and we know about the positive correlation of those two. Therefore, by the way, let me just open the correlation matrix here. This is a really great tool, which is included in the so-called MT5 add-on you can download on the website from Admiral Markets. Before we go over to the website and show you where you can get this, let's have a look here at this. So very interesting. You can choose, for example, the time frame we are currently looking at. This is daily. We have 200 candles looking at it, so it's in fact 200 days. And what you can see here is with EURJPY and GBPUSD, there's a plus 96. What does it mean? It means that usually if one goes higher, the other should follow, respectively. If one goes lower, the other should follow suit. And the interesting thing about this now is, and this is something I mentioned several times already in the past, the euro was quite stable, but pound sterling weren't really capable of taking on serious momentum, even though some numbers which were published here in the younger past were would have been a solid driver for bullishness in pound sterling. But instead, pound sterling couldn't really take off. I think main reason currently is the still difficult negotiations, let's call it, around the Brexit. And what to expect here? Will there be a hard Brexit? Will there be a negotiation towards a soft Brexit? Especially in terms of trade, what to expect here around this, and all this, and the skepticism around this obviously wasn't positive for pound sterling at all, even though some numbers came out as significantly better than expected. Retail sales data, for example, employment situation was stable. There was also a rate hike at the beginning of this month of the Bank of England with a quite interesting statement, which was more hawkish than I think many have expected it to be, while a pound sterling wasn't capable of taking momentum on, but sold off, in fact. And that was an inherent sign of weakness for pound sterling. And that's one of the reasons why I definitely favor the euro above the pound sterling when trading US dollar here and shorting the US dollar. And so nevertheless, the thing is that we made it here above a level which I made a topic last week that was back above 128 around, and nearly pushed towards and fell short of, nevertheless nearly reached this target around 129.60 around. And so what we can say is, yes, there is probably a chance that there will be a further momentum on the upside. Nevertheless, we have to make sure that we see the overall structure on the daily chart, which is still a sequence of falling highs and falling lows, meaning nothing more than the overall advantage is still on the short side. And this is the case until we make it back above 132. And so here in your in this context, probably we'll make it thanks to weakness in the US dollar for whatever reason, probably thanks to a push higher, final push higher, significantly above 116 euro, for example. We'll make it back towards 129.50, probably up to 130. Nevertheless, it's a potential short trigger, and we should be really careful for around anti-cyclical long engagements. I'm sorry, long engagements in pound sterling here. So one question. Yes. So there's a question from Werner. He says, or he asked, your long trade in EURJPY, do you do not consider the resistance? So I think I know what you're talking about. Let's just switch back towards EURJPY. So if we zoom out, you can see here there's a potential resistance on the upside here. This is the region around the highs. Yes, the simple answer is no. I don't consider it. The same is true here for this high. It's the 8th of August. So I definitely do not consider it because it's a purely systematic based approach, and I'm trading the long side because the system says trade the long side. I'm completely ignoring any technical signs or something. That's, by the way, an approach here which is interesting for some probably. And something worth mentioning here. So in fact, thanks for asking. So what I do and what I usually suggest, especially people trading such automated strategies, or in fact strategies which have a clear setup which you just follow, I consider this to be a so-called basic strategy. And my idea when trading such a basic strategy is in fact that the overall target of trading such a basic strategy is not only trade the strategy, but try to improve it / make it more profitable by increasing the overall expectancy of this strategy, so the expected value of the strategy. So what do I mean by that? Before we look into the DAX, let me just give you an idea here. And finally, by the way, we also, I promised to have a look here at the Canadian dollar. But first of all, let's have a look here at this average gain multiplied with the hit rate, and then we subtract. Oh, by the way, it's wrong. The average loss multiplied with the loss rate. So, and when talking about profitability in trading, we're talking about an expected value which is positive. So it's profitability in trading means nothing more than you trade with a positive expected value. So we can define our expected value, or not our, but the expected value, by multiplying the average gain with the hit rate, subtracting the average loss with the loss rate. So if the basic strategy over a long time span shows that we have such a positive expectancy here, that's the first positive sign, and we should probably trade this strategy then. Now, the next thing is, the interesting thing is, what do I mean by making it more profitable? This said, it means that I, for example, document my trades when I say, okay, I write down the overall result of my trading. And if I trade as the basic strategy trades, so if the overall profit of my trading today is 50 pips plus, and the basic strategy has a result of 50 pips plus, the difference is 0. And this is what I document in my trading. So I write down a 0 for today. Now, assume the following, for example, for yesterday. What did I do yesterday? I saw this push higher here in the EURJPY. That was yesterday. The breakout occurred. By the way, I didn't expect it yesterday too. So that's what I want to say around gut feeling and resistance line and everything. I saw this push higher and fell short of my take profit level of around 15 pips or something. So what did I do? I trailed my stop and placed it at around 128.45, 46 or something. It was stopped out then. The market didn't make it higher, but fell lower then here, or came lower into the evening. I was stopped out at 46, and the result, the basic strategy, the order or the trade was closed at 41. So when looking at the basic strategy, closing at 41, while I closed the trade at 46, my result was 5 pips better than the basic strategy. So I write down +5. If, for example, that also happened over the week, then if I, for example, have a result of 10 pips worse because the market pushes towards my target but didn't make it in the first attempt, and I scale out of the trade, for example, or I take out the trade then because I say, okay, I fell short of reaching the target of, let's say, 2 or 3 pips. I can't afford now to let the market move against me here. Again, let's say 50 or 60 pips if I didn't trail the stop. Well, this is something, it's not only from a mathematical perspective difficult, but it's also, and especially true for the psychological side of trading. So I sometimes scale out of the trade, for example, or I take out the whole trade. Then I see that my level is, let's say, 10, while in a short position here, the take profit is shortly afterwards reached. And I have to admit, okay, if I stayed in the trade a little longer, I would have made it to the take profit level. That said, my result then would be -10 pips, for example, if the take profit level is 0, for example. And that way I documented for many trades. And once I have, let's say, 100, 150 trades together, what I can do is I can sum those numbers up and I can see whether my interventions, my discretionary interventions here, make the overall basic strategy better, or if I make it worse. Let's say I intervene and I see that the overall result is negative, then I should definitely stay away from the basic strategy. Do not intervene at all, but just trade the setup, and that's it. If it makes it better, well, I'm on the right path here, and I smooth the equity curve. So this is how I approach, for example, this strategy. That said, the question is, okay, do you ignore the resistance on the upside? Yes, currently I ignore it. Nevertheless, when I spot over the next hours of trading that there is definitely not enough momentum built to make it above this resistance, it could result in me taking out, let's say, half of the position, so scaling out of the trade, which does not move into my direction. If I then see at the end of the day that my exit here, my discretionary intervention, made the strategy better, that's exactly what I write down in my trading journal. If it did not improve the basic strategy, but shortly after the market pushes above that level, I have to document this too, and then not only consider surely one trade, but all my trades, and at the end of, let's say, 150 trades or something, see whether I improved the strategy and smoothed the equity curve, or if I did not succeed with this approach. So this is in fact how I trade this this approach then. Okay, so I hope that it answers the question. Let's have a final look here at the DAX now. By the way, not only the DAX, but also the Canadian dollar. Probably the Canadian dollar with the GDP data next week on, I think it was Wednesday, is one of the most interesting currencies to watch here. Look at the DAX. So after last week's trouble, let's call it, in emerging currencies, we see that here the region around the lows from June and July could be hold 12,100 to 12,130 points. And now we see a pullback here, and by the way, not only a pullback, but the market is drifting higher, let's call it. So it's a very thin market environment. When looking, for example, at the 5-minute chart here, let's go over here to this day. And by the way, can we click? So this push higher here in the morning, for example, and then shortly after this push lower, what you can clearly spot is that the market, in fact, when zooming out of the chart, was or the bulls or whoever was the main initiator behind this move, he definitely profited here from a very, very thin market environment. So very, very, very thin market environment. There was a push slightly higher to new weekly highs, and then the market just fell apart again, made new daily lows, and there's now trading around 12,400 points. Nothing happening so far. And this is a clear sign. That's also true here, by the way. We failed again in the morning to make it above this thin red line. Yes, sure, optimists will say, hey, look at this. So there's rising highs. So some probably spot a so-called a rising wedge here, which is a bullish continuation pattern. And if we make it above that level, there's further room on the upside, which will probably push us towards, I don't know, 12,500 points and significantly above that level. But nevertheless, the thing is that when looking at the daily chart, the overall picture is not very positive. And even though the economic docket is very thin and I don't really expect much to happen, I think there's plenty of reasons to start to become really skeptical if this is a sustainable move. And in my opinion, if I had to take on a bet today, I'd say there's a good and realistic chance that there will be a push lower, bringing us to 12,100 points again here on the downside. And if we make it below that level, again, the thin market environment here, especially in the DAX, is probably the main driver then, which will lead to a quite sharp drop lower, at least down to 12,000 points. I'd go for the year lows, in fact, 11,700 points. I'm not saying that it happens next week, but something is worth remembering. September is known to be one of the worst months in terms of the overall performance in the DAX. So therefore, we want to have a look at the website from Admiral Markets. So in fact, what I prepared here is the weekly outlook from last Monday. But in fact, what we want to have a look at here is first this article. And on Monday, in this weekly outlook, you will also see the same graphic here. Nevertheless, you can already find it here via analytics and then the traders block. And it's the latest. It's the latest one, trade the DAX CFD with the open range breakout here on the traders block. What you can see is that the September stands out with the worst performance in history, by the way. So we go down or back towards 1958, 1959. Back then, the DAX, as we know it today, was called the Hardy Index here in Germany. Then it was till 19 1981, I think, from 1981 till 1987, 1988, we called it an index, which was calculated from the so-called Börsenzeitung. And then from July 1988 onwards, the DAX was born on the 1st of July. That was why Admiral, for example, offered a 0.5 a spread in the DAX, for example. But nevertheless, if you take all this data together, you can see over this time span that the September was by far one of the worst months ever, or is to be considered one of the worst months. And this is true for many equity indices. And this is something which is also, from a cyclical perspective, probably of interest here for those looking at the DAX currently, because again, this is a weak bounce against this level. And I think another attack towards this region around the June and July lows is quite likely to happen, probably within the next week of trading then. If not, the next week of trading at the beginning of September, I think we have a good chance to get to see such a push lower. And now the interesting thing is, and therefore I want to show you something. Now we want to look over to the US equity indices. So currently, this is the fear index, let's call it. So it's the CBOE volatility index. It's measuring how much market participants are currently paying for insurance for markets to collapse, in this case in the US. And the interesting thing is that after this sharp spike at the beginning of the year, so in February here, this volatility collapsed again. And when looking at the Commitment of Traders report, this is barchart.com, which offers everything for free here. It's a complete insight into the positioning of the big speculators for free. 1 second. So what we look for is the volatility index. It's the VIX. There we have it. And what you can spot is that we currently see the highest short position again. So we are looking here at the green line, the large speculators. So we are currently positioned at the lowest level shortly before we saw this huge squeeze here on the upside. So this is the first sign which should be carefully watched when looking here at this current performance in equity indices. So we are talking about the S&P, for example, the Dow Jones, the S&P especially, but also the Dow Jones, currently trading around their all-time highs. In fact, here the Dow Jones, as you can see it, let me just, can I move it here? No, unfortunately not. So the Dow Jones is still trading around 1,000 points below that, but in case of the S&P, mainly driven by mid and small caps, we are talking about 20 points or something, 30 points. So when looking at this performance here, what we can clearly spot is the market is definitely quite sure that we'll rather sooner than later make it to these new all-time highs here. So the problem is September is around the corner. September is known to be the worst month, not only for the DAX, but also for the US equity markets. But, and this is the interesting thing now, even though this looks not very promising here, with market participants being positioned very aggressively on the short side again, when looking at this chart here, or at this statistics, things start to be really, really interesting. This is, by the way, something. This is statistics from someone. He's called Ryan Detrick, and he's from LPL Financial. He's part of a research team from this financial company, and he's very strong in statistics. So I highly recommend following him on Twitter. So these statistics here are really, really worth a watch. And the interesting thing is, now listen to what I have to say. Currently, the S&P, so that was from yesterday, shortly before the trading day started. So these numbers are probably not 100% correct anymore, but volatility is low, so it's not a big difference. So the S&P 500 currently is up 1.6% in August, and there's only 1 week to go now, next week. And the economic docket is thin, so chances are probably high that the S&P will show a profit at the end of August. So this is interesting because since 1950, the S&P has been higher each month between April and August only 5 times. So it was 5 times, and so far it was April, May, June, July, and August. Then, if we close higher, those 5 months, if we closed higher, that would be the 6th time then. And the interesting thing is, look at these returns for September. In 1958 was plus 4.8. 1980 was plus 2.5. In 2003, okay, that was the only negative year with 1.2%. I, by the way, have no idea currently, that's something I haven't prepared yet, what was the overall average return in September here on the S&P 500. But again, 3.6 in 2009, 1.9 in 2017. So chances are high from this perspective that the September, even though the picture does not look that promising, and we're looking at all the numbers in the past, or not only in the past, but when also looking at the current insurance paid, when looking at the volatility indices, showing that there is some kind of confidence that everything's fine and everything's great. When looking at those numbers here, chances are good that September will not turn such a negative result, which you usually expect to see in September then. And by the way, the same is true, by the way, for the final 4 months of the year. So in all cases, by the way, and also in 2003 then, all 5 cases before the S&P showed a profit. So from this perspective, the chances are very, very high that here, not only the Dow Jones, but also the S&P in this case, will really turn a profit. And even though it looks not very promising, again, when looking at the overall geopolitical tensions, when looking at the numbers being presented from Wall Street here, especially when looking at the FANG sector. I mean, yes, Amazon and Apple still performed really an extraordinary well, but there's, I think, not enough speculation anymore that there will further gains so likely. So I mean, sometimes you can hear the saying, the sky is the limit. Well, I think finally we reached this limit, or we reached the sky already when looking at the numbers from Apple and Amazon. And rather sooner or later, there will probably a moment when things start to turn sour and turn around, and we get to see a similar sharp drop as we've seen in February. But when putting all those feelings aside, all those gut feelings that something's wrong there, and looking at the fact from clear numbers from a statistical standpoint, then we have to say currently the picture is quite bright for the U.S. equities in this case. And now the only question is, can the DAX profit from this? If you ask me now, if you put a gun to my head and ask, I'd go for no, but not necessarily because I do not trust the numbers. But what I do is I look at the overall performance here in the DAX, and I consider this performance to be quite weak based on all the fears and speculations around the trade war between, in this case, Europe, the Eurozone, and the US. And I think this is taking away much of the positive outlook for the DAX here. And makes it more likely that we'll see the push on the downside. And if, by the way, and statistics from time to time are wrong, if the US equity markets are hit by for whatever reason and push lower, I think based on all those fears around the trade war, the DAX has some extraordinary outperformance potential on the downside compared to the US equity markets. It's also something which we should take in mind here. So finally, let's have a look at dollar Canadian dollar. We'll hurry through this. Let's here look at those can be closed. Let's have a look here at the economic calendar. Next week, GDP growth rate. So numbers from Canada were really promising over the last weeks here. There was also the comments from Stephen Paulus, who said that rate hikes are necessary, and so currently swap markets are pricing in a 70% chance and higher that there will be at least one rate hike in Canada from the Bank of Canada into the close of the year, so at least 25 basis points. And interestingly enough, we saw already before a significant push higher here, and it's a clear bullish breakout. In fact, what we've seen in the dollar Canadian dollar. 1 second. So it's a clear bullish breakout. And when looking at that at this formation, at this potential rising wedge in this case, the projected target on the upside can be found around those highs here from 2017, probably even higher than that, around 140. So if we combine all this, the overall outlook for dollar Canadian dollar, even though the fundamental side and also the rhetoric from the Bank of Canada is in favor of the Canadian dollar, the overall outlook for dollar Canadian dollar is bullish when looking at this picture. But now something interesting is happening. Numbers outperform, and what we see is that after a retest here and the first attempt already here, that was in July, it's clear that obviously dollar can't really take on momentum against the Canadian dollar here. So what we see is the first attempt pushing higher, it fails. We push lower instead. We see another attempt pushing lower, and now things start to get interesting. These lower highs here are a first sign, in my opinion, that the bullish momentum in dollar Canadian dollar is diminishing. And if next week's numbers around GDP are coming in better than expected, I think chances are really good that the dollar Canadian dollar will not make an attempt here to make it back above 132 and go for these highs again, but instead will push below 130 and probably push lower from there, targeting then the region, first target around 127.50. So all in all, my picture for the Canadian dollar is positive based on those developments here in the upcoming weeks. And with the push below 130 in dollar Canadian dollar, further momentum on the downside should probably be expected. So, and that's it from my end. I hope you enjoyed this webinar, and I wish you a nice weekend. Enjoy yourself. If you have any questions, please feel free to contact Admiral Markets so that they can forward them to me and they can answer them. I'd more than appreciate answering your questions. And yeah, talk to you again then next week on Friday. And till then, happy trading. Watch your stops and have a nice weekend. See you and bye-bye.